What's going on, fam? Hope all is well. Oh my God, I can't even talk. Hope you guys are having a good morning, afternoon, nighttime, whatever the case may be. Whiteboard is still crooked. Still have yet to fix that, but I will. Do not worry. Today's lesson, we are actually going to be covering how to not let your green trade go red. Or how to not let your green trade go red, how to just basically have the best risk possible when you're entering those trades, because I know many of you have had multiple different scenarios where you've entered a trade, it was green, you were in profits, and then it completely flipped on you because you either weren't able to trim, weren't able to have your stop loss in the correct position, etc. So I'm going to go ahead, hop on the charts real quick, show you guys a couple of things, explain to you guys a couple of things. It'll be a quick, easy, sweet, valuable ass lesson. So let's go ahead and we'll get started. And I will make my camera smaller. Boom, 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 boom. Here on Spy, per usual, you guys already know. So, first thing that I mainly want to go over is when you guys are entering your trades, we obviously have our stop loss always in position. You guys always need to make sure that every trade that you're entering, you have a set area for your stop loss before you even enter. Because if you're just entering blindly without even your risk analyzed, then you're going to get screwed over, and that's just a fact. But when your trade is moving in profits, right? Let's say that we're trading right here, we're entering right here to go long or buying calls. When your trade is in profits, the smartest idea for you, because I know a lot of people keep their stop loss in the same place, which you can keep your stop loss in the same place at all times. But for me, what I'm typically doing is I'm moving my stop loss up as price moves up as well, due to the fact that I know market isn't always going to be moving in my desired direction at all times. Yes, I will be able to catch the moves or whatever the case may be, but the market can flip on me at any certain time, right? So I always want to make sure that as price is moving up, I'm also moving my stop loss up, because um, if I were to keep my stop loss at the same place, I would be exiting at break even, or I would be exiting at negative 5 to 10%. But let's say that my position is moving up 10, 20, 30%. Let's say that it was at 30%, and now I move my stop loss to 15% if price went below that. Now, rather than um, leaving my stop loss at the negative 10% level, I left my stop loss at the profit 15% level once my trade hit 30%, right? Rather than just being too greedy and expecting the market to do exactly what you want it to do, right? So you're just simply moving your stop loss up as price continues to move. Now, you're probably wondering, where do you exactly move it up to, right? Because you can obviously just move your stop loss up as price moves up, but what I do is, as price moves up, I look for key levels to be created. So in this case scenario, we can see price moving up, and now I see a 1 minute fair value gap created, right here. Simple. um what's going on here? I'm not sure. I'll create it with the lines. So we have a 1 minute fair value gap created. You guys can see the gap between these lines. So what I would just simply do is, now that I see this barrier, this fair value gap created, which is likely to provide buying pressure, I'm going to put my stop loss under that gap, under that level, right? Which you can see I did exactly right there. Obviously, I'm not taking that trade. I'm just showing you guys for as an example. And then you can see price literally bounced and retraced exactly to that fair value gap, to our new stop loss, right? And we didn't even got stopped out, and then price continued to move up higher. We still like had the same thing here, but that's just a key scenario of why you always need to be moving your stop loss higher. So if price does move against you and doesn't move to the target that you wanted it to move to, you still have your exit level at a profit point, right? That stop loss doesn't become a stop loss for you anymore. It now becomes an exit point for profits, right? Only if your trade is obviously moving in your desired direction for a certain amount of time. So that would be the first thing, is obviously moving your stop loss as price moves, but not just moving it to a random direction, moving your stop loss to key levels that are created as price is moving. So that would be the first thing. Second thing, which is also the main thing, is trimming or sizing. Having the correct sizing in these trades. I see many of you just enter and never trim or never cut off a certain amount of your contracts once you guys reach like 20-25%, maybe even more. You still have your full position sizing. You guys always need to make sure at that 15 to 20% mark you are locking in profits, right? You are at least selling a one or two, or depending on your contract sizing, you're selling a couple of contracts once you get to that 15-20% mark. Because A, you always want to make sure that you're locking profits in, and B, just how I explained to you, and in step one, even if price moves against you and does stop you out, the losses aren't even going to be that big, to the point where the wins that you had on the first trim are going to overload on the losses. So that trade doesn't even become a loss to you, right? It's a win due to the fact that the wins, aka the trim that you took, overloaded on the stop loss when price reversed on you. So that's a very, very big thing. You guys always need to make sure that you are trimming and you are selling contracts as your price moves. And it's literally almost, it's kind of like the same concept as I was explaining to you guys in the previous step as well, is if you're wondering on where to sell your contracts at or where exactly to trim. Obviously I said the 15 to 20% mark, but you always want to make sure that you are trimming and selling your contracts at key levels on the chart, right? Because those key levels are areas where price is likely to reverse. So you want to make sure that you are exiting, or you are at least securing profits at that key level if price does reverse on you. It's very simple, but many of you don't understand or even just don't do this. So this is just something that is very important. You always need to make sure that you are just always just simply trimming when you're securing profits, and B, always trimming and locking in a piece of your position slash profits when price does reach those key levels. When I say key levels, I mean like resistance, I mean fair value gaps, I mean supply zones, demand zones. You guys get the point. It's just very, very simple, but like I said, many people just fail to even bother doing it. So that would be the two main things that I actually wanted to cover. Really, just moving your stop loss and having your stop loss at the correct point. I wouldn't even call it a stop loss at a current point, at a certain point, because once you're moving your stop loss up as your position moves in profits, that stop loss isn't a stop loss for you anymore. It's an exit point for profits, but it's not the highest exit point that you could have gotten, but it's still an exit point for profits, right? So would you rather have gotten um, a less amount of profits, or would you rather have gotten stopped out for 10%? So it's very simple. Just make sure that you are applying these key things, doing these key things. I'll see you in the next lesson. Let me know if you have any questions. Much love.